Afternoon, guys, again. Sorry, we got cut off there at the end, but we had completed our operating activity section. All I needed to do towards the end was just to total the session. So the operating activities, if I were to sum up all our operating activities using all the amounts I had inputted, I would get to an operating cash outflow that we've made in the business of negative 85. Which means your operating activities right now are not generating any cash flow for you. But that makes sense, as this business was newly established. You would have noticed for all these balances, accounts receivable, inventory, all of them, they had started off at 0, which means we had just established the business. So we didn't have any closing balances from last year. We used 0 as the closing balance from last year. So our operating activities are currently sitting at negative 85. Okay, let's have a look at our investing activities and our financing activities. Okay, our investing and the financing activities, remember I said to you that for your investing activities, you need to look at your non-current assets, and your financing activities, you need to look at your non-current liabilities and your equity. Okay, let's start with investing activities. So for your investing activities, these are reflected here as these land and buildings and delivery van. During that year, we had land and buildings increase from 0 from last year to 610,000 this year, and our delivery van as well had increased from 0 to 3,000, which means if they increased by that amount, we must have purchased land and buildings. And if you are purchasing, remember it's a negative. The money is coming out of your business of 610, and you've also purchased a delivery van of 3,000. Remember not to get confused with the depreciation. If your depreciation here had been 500 and this balance here had reflected as 2,500, you need to remember that the amount you paid for that delivery van is still 3,000. It's got nothing to do with that 500 depreciation balance. Okay, so what's important to look at here is that had it been 2,500 and it included a depreciation of 500 during that year, you would need to add back as well that depreciation here and show that the cost of the delivery van to you when you purchased it for a balance of 3,000. Okay, if I look at my non-current assets section, I don't have any other non-currents. I can highlight those in green. I'm ready to go. I've already dealt with all my non-current assets. You have to deal with all your balances. You've dealt with all your current liabilities. That should be green. You're basically almost done. Remember, the only thing you leave out here in your assets is your cash balance, because you're actually working back. You want to get back to this 86915 in your cash flow statement. Okay, so here we've done our investing activities. We've purchased these assets. We are investing in our business, quite a large investment in our business. We made investments worth 613,000 during this year. Okay, where were those? Those needed to have funded from somewhere. You couldn't have purchased 613,000 worth of long-term assets had you not purchased them with some form of financing. So what I'm expecting to see here, given that I didn't make any operating activities and given that I actually had invested in my business, I must have funded my business somewhere this year, and I expect this to be an inflow because of this huge amounts that you're investing in the business. Okay, so if I look here at any long-term assets, there weren't any long-term assets in the business. You only had current liabilities, which means you didn't have any long-term liabilities. So you didn't take out any debt facilities, you didn't take out any development finance loans, long-term loans. All you had was a share capital and premium here. People have actually issued shares to the shareholders. They pumped in money of around 700,000 Rand. Okay, so if you go back to this cash flow statement here, you had an issue of shares of 700,000. Okay, if I total my movement for the year, that's my financing activities, my total. My cash at the beginning of the year was sitting at 0. My cash movement during the year is sitting at a balance. I need to sum up all the investing, operating plus investing plus financing. I'm sitting with a total cash movement of 86915. That makes sense to me because my cash at the end of the period is sitting, you sum up this opening and the closing balance, which is 86915. I'm happy. This amount here totals the exact same cash balance that is sitting in my balance sheet here of 86915, which makes me very happy, which means my cash flow statement has also balanced. Okay, so remember to also reflect your cash at the beginning of the year, your cash movement during the year, and you also then need to reflect the cash at the end of the year. And this needs to sum up to your balance sheet item, which is your cash and cash equivalent balance here of 86915. If you look closely, we've dealt with all the items here under non-current assets, under current assets, under current liabilities, and we've also dealt with the share capital and share premium. Remember, the retained earnings you've already pulled from the profit figure where you've actually brought in your operating activities, your profit before interest and tax, because this is just purely coming also from the income statement, so you don't want to double account those. So you're only dealing with any other items besides cash and retained earnings in your balance sheet. Okay, because I've dealt with all the items, I know that my balance should balance to the 86915. Okay, so if I look at this business and I analyze this cash flow, if we look at the analysis section here, if your cash flow from operating activities here, these are all positives. Okay, we've got a negative balance here. Okay, our investing is also negative here. And our financing activities are positive. The company does not generate enough cash to fund operations or capital expansion. New debt is issued. In this instance, it wasn't new debt, it was a share issue. And long-term, it's a typical of a startup company, which makes sense. In our example, the example limited actually started off from scratch. It had 0 opening balances for all the balances. Remember, for all these, you had to deal with movements rather than balances. And so because it is typical of a startup, they're initially making losses here under their operating activities. They're still funding heavily in the investing side of the business, and they're getting quite a huge cash injection either from the shareholders or from debt obligations that they're putting on balance sheet. And that actually makes sense to me. This business is still investing, so you can't be too harsh on them making negative operating activities. But that's how we also analyze your investing activities. Is the business liquid at the moment? Now we need to assess in the next year if they manage to improve this negative 85 and they start making profits year on year. Then we can assess whether this company will start making money. But this is a very good example to look at. Please have a look at your slides and try and actually do this example limited once again for yourselves. Okay, thank you.